allocation is subjective and is based upon the facts at hand in any one case. And we're going to now spend the next 4 or 5 chapters talking about different times and different ways to allocate costs. For whatever reason, in this first chapter about cost allocation, it really does a bit more, we'll do a bit more variance analysis because we enjoyed that. So we'll talk about we'll subdivide the sales volume variance, which the sales volume variance is one of the variances that you calculated on the homework that I gave back today, or the classwork I gave back today. We'll also talk about how do you analyze the profitability of a given customer, which involves allocating costs amongst customers. So let's see where we go with this. So why do we allocate costs? Because you need to get complete information about a cost object. And a cost object could be a product so that we can properly price it. It could be a department, how well are they doing, or a division, how well are they doing. It could be the cost of doing a project. It could be the cost associated with a customer. So a cost object runs across a variety of different parameters. So the purpose of allocation is to provide information, maybe because you want to decide on a selling price, to motivate managers, a very important part of cost allocation. You want the manager to understand their full costs, including those that are allocated to them. You want them to do the right thing, knowing those full costs. So it's very important that they stay in a cause and effect relationship with the allocated costs. When they receive an allocated cost, in order for them to feel ownership of it, they must feel that it's reasonable. So you allocate to motivate. You might allocate to justify. Let's say you have a cost plus project. You need to allocate costs appropriately so that you have your costs in the right buckets so you're pricing fairly. So maybe charging it in to a government project wouldn't be a great idea. And ultimately you want to do it to measure your income and your assets so that you can do your reporting to external parties correctly and you can do your tax reporting correctly. So it's an allocation. You know, many costs are direct. There's no allocation there. They go directly to whatever object they should be going to. But cost allocation assigns indirect costs, including corporate overhead, to objects. And you have to allocate because you can't trace. And sometimes they comprise a large percentage of a total cost. So this is the simple diagram about cost allocation. Let's say the cost object is a division of a company. They absorb some direct costs, labor and materials. They have, from within the division, that allocations that need to be made to various products. Then you have kind of indirect costs that are coming in, that are from the division. And then they have all those other corporate costs. You know, might be from the various support services of the company. The Treasury Department, the Accounting Department, similar. Human Resources, IT, Admin. These are divisions of the overall company that are adding value to this division, and those costs have to somehow find their way with the appropriate driver to this division. So that's really what this picture is showing. So there are a few different criteria for allocating costs, I'll tell you right now, the best is cause and effect. It's the most credible. If you're using corporate IT services and you have 40 people assigned to support your division, you should get to charge those 40 people. That's cause and effect. If you're the one with the crazy idea to drink the tequila, maybe you should pay for everyone's cab home because they couldn't drive because of you. Cause and effect. Another model would say benefits received. Rather than what you used, it's what value you got. If you're driving the furthest, you should pay more. You receive the most benefit in whatever model that each group. Most people came up with this as the model for the taxi situation. Different economics, but came up with that as the model. Some kind of proportional cost based upon benefits. Fairness. Establish a fair price that in the real case will be satisfactory to the government. So it's considered reasonable or fair. It seemed like a lot of people thought that because Wen made more money, it's fair that she should pay. And that's really what ability to bear is. I apologize. Ability to bear is Wen should pay because she makes more money. Allocate in proportion to their ability to bear. You have two divisions, one very large, mature division, and one startup division that's just trying to get its footing. You might have the larger one absorbing some costs because they can. More often than not, cause and effect and benefits received are the proper way to go. Because these, fairness is okay, but it's subjective. And ability to bear, that kind of incents that smaller division that can't afford it to just use resources haphazardly because they're not paying for them anyway. So you don't create the best decisions out of ability to bear. We have an example. Smith Corporation manufactures washers and dryers out of two divisions, a washer division and a dryer division. Your total treasury costs are $600,000, HR is $1.2 million, and other administrative is $4.8 million. The treasury costs fall in the category of interest expenses that were used to finance equipment. And you see finance $4 million of equipment in the, I think this is the washer division, and $2 million in the dryer division. They also had their own internal costs in those divisions, both direct and indirect. And so these were their internal costs before the allocation from Treasury, HR, and administrative. Let's see how we might allocate them. The total Treasury cost was $600,000 based upon the fact that they had loans outstanding and they were paying interest. Well, that should be allocated cause and effect based upon the amount of loans for each division. So the Canton division should pay 2/3 of the $600,000, and the Dayton division should pay 1/3. Cause and effect. They had twice as many loans. HR is quite often allocated based upon your head count in the divisions, or direct labor costs. So our direct labor costs are 1.2 and 1.8. So how do you allocate the $1.2 million of HR? It'll be, I think this is 40% and 40% and 60%. Somebody can correct me if my mental math is wrong. And they don't choose to allocate corporate overhead. That's a choice of the company. They just don't feel there's any way that they could do an appropriate cause and effect allocation. So the company will just absorb corporate overhead. So their allocated costs are as follows. And you would just add that to your internal cost to find the total cost in the division. Second category of costs are customer profitability, or cost allocation is customer profitability analysis. To understand how valuable various customers are to your company. Remembering that sometimes for some customers you're forced to discount. They're better negotiators than you. And you should understand the impact of discounting by customer and by salesperson, because you want to understand which of your salespeople are not bringing in the value that you think. You know, you could have a salesperson that's bringing in all kinds of revenues, but if they're not bringing in profit, then they're not doing their job. The customer cost hierarchy. This is very similar. So this is how you allocate. This is what, you know, we loved this the first time we did it, about 3 weeks ago, when we had kind of batch level and sustaining level. Remember that? We loved it. I remember. So you have a similar hierarchy as you're allocating costs to customers. You want to understand the activities that you're doing with each customer, and then figure out what's the allocation basis for each to each customer. So let's see what we're talking about. You have unit level costs, batch level costs, sustaining level costs. These are all at the customer level. Relatively straightforward to do your allocations. Distribution channel costs and corporate sustaining costs are not at the customer level. Less specific to a given customer. Is this coming back now? A little bit? Well, it's kind of on the midterm because we did it before. So you have, don't get caught up with this whole chart. I'd kill you guys if you had a chart like this in a presentation. You have 4 customers. You have revenues and with discounts and, you know, direct costs related, and therefore a gross margin for each customer. That's what we're doing here. You then have specific customer level operating expenses that you can now allocate to your customers. Product handling costs 50 cents per unit sold, and you know your units sold per customer, so you can allocate a cost. Orders cost $100 per batch. You know the number of batches per customer. Vehicles, I forget what the allocation basis is there, but it's channel based. And then these two are customer sustaining. Rush deliveries. You know, if a customer demands rush deliveries, that's going to cause you to incur additional costs. And if your salesperson has to spend a lot of time visiting and hand-holding, that's going to be costs. So you not only can understand your general costs of producing and delivering goods to the customer, but also some of the customer level costs that you have. And even though just on the cost of the goods, this looks like a profitable customer, once you look at the way you have to handle this customer, it's disproportionately expensive. While it's a small number, it results in it actually being a non-productive customer. And then you need to make the decision, what do we do? Do we raise the price on them? Do we accept it because they're absorbing fixed costs and that's okay? Or they're absorbing fixed costs and that's okay? Or do we say, you know what, we're better off not doing business with this customer any longer because their costs are greater than their costs are greater than their revenues. Their variable costs are greater than their revenues. As you look at your profitability, like any other analysis you do, it has the numbers, and then it has the soft issues, the non-quantitative issues. You need to understand if you raised prices because your profitability isn't right, do you run the risk of losing the customer, and is that good or bad? Sometimes, these next two are together, you might have low customer profitability in the short run because you have long-term opportunity. When I was a partner in management consulting, it was a normal thing for us to do to have these things called wedge projects, where we would sell relatively small projects and deliver on relatively small projects, not expecting to make a profit on them because it's a customer that we really want to have at the company, and we're prepared to take small short-term losses for long-term profitability. And it's a very natural part, particularly in the service industry, to do that. Auditors do that too. If they're trying to steal an audit from another auditor, or there's probably a nicer term, but that's essentially what they do. They may go in on a non-audit related project, not charge too much, but show their capabilities so that the client will have in their mind they have another alternative, and then create future value. On the other hand, when I was at Goldman, we would have people coming to us all the time to do things for cheap or close to free, because to have Goldman as a client is it was a feather in their cap. And so they were happy to take a loss for long-term reputational value to them. And then finally, this happens all the time. You might, you want to improve your business, so you take on clients at a loss, customers at a loss, so you get knowledge. An example of that is when we were at Goldman. This is years ago. I mean, everything's automated now, but we did some of the first automated systems on the New York Stock Exchange floor. And we actually, my group actually created a handheld device. This is true. A handheld device for use on the New York Stock Exchange floor before anyone had it. And we created it made out of Legos. Legos, you know what Legos are. Just to have a proof of concept. We then went to the market, and we had somebody, a firm, turn that into a real product that they sold to us at a very low price, gave us a 2-year window where they could not sell it to anybody else, and then to give us a head start and to give us whatever value added over the competitor we would have. And then after 2 years, it became the standard in the New York Stock Exchange. And they were the only ones selling it. So an example where they were happy to have low or no profitability in the short term for a long-term opportunity. So, and they learned from us because we created it, right? So different ideas on how you evaluate customer profitability, not just the bottom line numbers. Okay, let's do an example. During the first 6 months of 2013, English Language Institute expanded its market, and they started to sell to 2 new customers in Mexico. They sold 2,000 composition programs. Customer A is in Tijuana and B is in Guadalajara. So they sold 200, they sold 140 to customer A, 60 to customer B. Here's the list price. They clearly discounted a little bit more for customer A. And they brought in this much revenue. clearly the revenue differences are because of the number of units sold and the discounts. So if you do variance analyses, that's what you'd see. So they want to figure out, were these profitable customers? And they use an activity-based costing system, and they know that they have $80 per purchase and $100 per batch for order taking and setup. Customer A took a disproportionate amount of order taking and batch time and batch setup time. So let's see what the cost of servicing each product was, or each customer was. Customer A had $1,200 in servicing costs. And which hurt their profitability. And knowing that they would then go back probably to those customers and see if they could change the business model so that they could reduce this $1,200. Customer B had much less. So which one was more profitable? If both brought in operating income, you probably would keep both customers, right? But on a per unit basis, both because of the deeper discounting you did with A and because of the ancillary costs, it's bringing less income per unit than customer B. So customer A's profit percentage is 40%, 40.6%, and customer B is 43.9%. Okay? So this is customer profitability analysis. Okay, variances. Sales and marketing variances. This is going to take that sales volume variance and break it down. You want to understand, when you sell a certain amount, what's causing your profitability. Do we have the proper mix of products? Are we getting the market share that we should be getting? Are we in a growth market? You could do this in a couple of ways. You could do it with variance analysis, which is what we're going to focus on today. Or you could look at your numbers year over year or compare to a benchmark. The benchmark could be the industry average or what the industry leader is doing, etc. So let's go back to last week as we were talking about variances. 2 weeks ago and last week. We start off with a static budget variance, which is just the difference between the actual results and the master budget. You then have two sub-variances, the flexible budget variance and the sales volume variance. And what you do there is you take the flexible budget, you flex the master budget based upon actual volumes, and you determine how much is due to price and how much is due to volume. We're going to focus on the volume component today. We had not focused on that yet. The sales volume variance can be broken down into a quantity variance and a mix variance. So, we're here. So if you think about all of your sales variances, you have a price variance, which we've already talked about, and a volume variance. The price variance is how much of your flex budget was due to price. This is how much was due to volume. That gets further decomposed now into a quantity variance and a mix variance. How much in total of all your goods, did you sell? Different than expected. And how does the mix you actually sold of product A and product B compared to what you expected to sell of product A and product B individually. The quantity variance can then be decomposed into a market size variance and a market share variance. Market size, was the market bigger than you expected or smaller than you expected? And a market share variance, were you getting your fair share of the market or getting the share of the market you expected? Or are you getting more of the market or less of the market than you expected? Obviously, to get this, you need information outside of your company for the market size and the market share. This is what I think I just said. Okay, we're back to English language. Let's look at their master budget. They have 3 products: a grammar product, a translation product, and a composition product, with selling prices per unit, as you can see. Grammar being the largest, right? And a cost, the variable costs for each of those products. So therefore you have a contribution margin per unit. You can see the composition product has the highest contribution margin per unit. This is just repeating that contribution margin. Number of units they sold, so therefore their total contribution. The sales mix is based upon their component of the total contribution. It's not based upon the number of units, right? So your percentage in the sales mix is, I said that wrong. It's based upon the total units, not the total contribution. It's definitely based upon the number of units. 15% is 735 over those 3 items added together. Okay? So that's your sales mix based upon the total units sold. The total contribution margin is just the sum of all of these. And this is the budget. Here's the actual. Okay? So here's their actual contribution margin per unit. And just extending that out. You see the sales mix was slightly off using the actual unit volumes. Okay, this is all background information. Let's go into the variances. The static budget variance. This is their actual results. This is their static budget, the master budget, if you would. And we see that they are under budget in total by $13,000. Translation did better than expected. The other 2 are under budget. Now let's look at the flexible budget, just to get it out of the way. These are the actual contribution margins per unit, extended by, that's the actuals. And the budgets. The flexible budget amount uses the actual volume and the budgeted price. And you can see that that's favorable. So your flexible budget variance is favorable. See the sales volume variance. That's unfavorable. So this is what we're going to focus on now. We sold less than expected of grammar. We sold a little bit more than expected of translation and less than expected of composition, resulting in a total under budget situation. Let's break that down now into a quantity variance and a mix variance. Quantity variance. You take the actual units of all products sold and subtract out the budgeted units of all products sold. And you multiply it by the individual sales mix percentages. Notice all products sold, though. It's not based upon the mix there. So let's see this. We know that this is the raw data we're working with. This is the total of all units, actual and budgeted, the individual sales mixes and the prices, and that's your total variance due to total quantity sold. So your total sales quantity variance is 26,000 out of your 30,000. You're going to get to do some of these, okay? I promise. Because you want to. And because it's very hard to follow it just going through numbers as we are. And I know that. Now you look at the mix variance. You take the actual units of all the products and you look at the mix differential for each product. Did they sell more or less of that specific product than expected? That's how you get to the mix variance. This is just like the variance analysis we're doing up until now. You take each variance and you subdivide it into two, a quantity component and a mix component. Now this is the mix component. So you take the total times the mix variance. So this is the remember the total variance was 30,000 or so. This is the remainder of that. So the problem was really you sold less of everything. You had a little problem that your mix wasn't exactly what you wanted. You weren't selling enough of the more profitable stuff. But the main problem was you just sold less of everything. And that's what you can take from this analysis. The only one you sold more of was your least profitable of all of your products. Translation at $37 was bringing in the least contribution margin, and it had more actual part of your mix than your budget. Market share variance. You expect to have 20% of the market based upon your understanding of the market, and the expectation is that within this region, the entire market was 24,500 units. In fact, the market was much bigger than you expected. So you had a bad year and the market was growing. Right? So we have a problem. I think just by seeing these numbers, we can guess that we have a market share problem. That our market share will be less than the actual market. So our actual market share was 16%, not the 20% we expected. So let's, we do the variance analysis there. First, we figure out what our budgeted contribution margin is across all units. That's 66.40. It's a weighted average. You guys know what a weighted average is, right? Yeah? So it's a weighted average across all your units. So the market share variance. You take the actual market size, which is bigger than the budgeted market size, and you take your actual market share, 16%, and subtract out the budgeted market share of 20%. And then you take your weighted average budgeted contribution margin. So, a serious problem. You were under the market by quite a bit. In a growth market like that, you should have expected more. And that amount is really the difference between those two things. Your actual market share versus the budgeted market share. That's what causes the market share variance. And same number. So that's your market share variance. The market size variance says you use the actual size versus the budgeted size. We know it's a bigger market. And you multiply that by what you budgeted your market share to be, 20%. And then you use that weighted average contribution margin. And that is 48,000 favorable. Not a surprise. The market size was growing. You expected to make more money. So you have the 78,000 or whatever that was, 74,000 unfavorable, the 48,000 favorable. They don't offset each other completely, right? They add up to your quantity variance, which was a negative 26. This is just another way to get at those same numbers. 48,000. So just to wrap this up, this 48,000 favorable, going backwards now, 74,000 unfavorable, will add up to your overall quantity variance, which is 26,000 plus unfavorable. They are the two components of your quantity variance: a market size variance and a market share variance. Okay, let's just do a little bit of work here. And I know it's tough to listen to this. I get it. I get it. So the best way to feel it is to do a little bit of work. Okay, first question. What's the answer? A, B, C, D. Sometimes it's true, sometimes it's not true. Your sales mix is what defines that. Okay? Work on this with your team. When you're ready, bring up your answer. And then you can, well, let's take a vote. Who wants to do some discussions on the midterm? And who just wants to go? You will lead the discussions. Okay, so if you want to go, just do this with your team, bring up your answer, and then you can go if you want to. Otherwise, we'll just wait for everyone to finish, and then I'll hang out and talk about the midterm. I'm not sure. You're going to lead me through it more than vice versa. So work with your teams on this. You're going to be calculating the market share variance. I recommend going, and I know we were going relatively fast through it, go through the numbers. Go through what it takes to do the market share variance.